All right, so welcome into the live stream today. We're going to be jumping into the macro pressures that often will face markets. And of course, you guys as investors are always wondering, where are the buttons being pushed that cause these markets to move around, both in the crypto space, but also in the traditional finance side? I'll break all that down today with special guests. My name is Paul Barrow. Welcome back into TechPath. As you guys know, we bring on analysts, macro specialists, economists from around the world, and we really try to drill into what is causing and what gives us kind of a pathway to manage what's happening right now from a global economic position. And today is no different. We're going to jump into it deep with Alfonso Peccatiello, who is also known as Macro Alpha on Twitter, but also runs a newsletter that I love called the Macro Compass. So great to have you on the show, Alfonso.
Hey, Paul, such a pleasure to be here. Thanks for having me.
Excellent. All right, so let's get into obviously the framework of where the United States, many people, even though our show is global, we get about 40% of our audience is US based, and we have a large percentage of our audiences all over the globe. A lot of European, we do have quite a bit in Asia, and people even, from a standpoint of Australia, South America. But you look at the global economic pressures that are being placed on, in most cases, I think all markets out there, the United States and what its market kind of guides the scenario, obviously, with the reserve world currency. When you look at some of the things that are happening right now, I was just looking at kind of a line list of the economic data this week, because this will, of course, get into some of our questions. We have the Fed Manufacturing Index, housing starts coming up today, building permits, retail sales, Fed FOMC minutes, the jobless claims, all of this is coming. So you can kind of see the lineup of scenarios. This is a very important week. Most likely will have some effect on the market. I want to get to the first question to you, and that is, when you look at the current situation from inflation, current interest rates, or other economic lagging indicators, what area are you watching the most right now?
Paul, I try to look at leading indicators first, but also the impact that those are having on coincident and lagging indicators. That's basically my framework. So what I'm focusing on is a bunch of survey and sectors that are leading the economy, generally speaking. So the housing market is, generally speaking, a good leading indicator for the business cycle, but also the many other relevant surveys that the United States or other countries actually have to grasp what will be economic activity going forward. We got one example yesterday with the New York Fed manufacturing survey, which came in at a very weak level. Now, interestingly, if you are a macro analyst or an investor, you should be interested in nuances, not only in headlines. So what I did is I went and looked at the subcomponents of this index. And you can see there that all the leading economic subcomponents of the index, like new orders, for example, or new orders to inventory ratios, they're showing levels that are pretty weak, as weak sometimes as in 2008. If you look at the employment side of that subindex, you also see some weakening pressures emerging in the labor market. And this is a survey that is basically submitted to 200 CEOs in the New York State. So it is a relevant gauge of current and future economic activity, and it is not looking good.
All right, so obviously a bit of a micro aspect, but New York does have, kind of the leading consistent when it comes to manufacturing numbers out there. And with that being the case, we knew, and I think a lot of people, at least on our show, we've kind of talked about supply chain most likely catching up. We were going to start to see rising inventories, obviously with manufacturing. This is now proving to be the case, most likely going to have some effect on pricing. Overall, that will affect inflation. How long before we start to see this really come to fruit in the marketplace, where we do see inflation numbers starting to address these high inventories that eventually will start to be real?
Great question, Paul. And generally, my macro models point to a lead of roughly 3 to 4 months from these subcomponents of these surveys, effectively, the inflation subcomponents of the surveys playing out into the inflation numbers themselves. So you should start to see some more meaningful downside impact because of the high level of inventory buildup, and also because if you look at the subcomponents, which are, for instance, the time to delivery of certain goods or supplies actually coming down very aggressively. When you look at any gauge of the supply chain bottleneck, it's actually reducing as well pretty aggressively. So when you have basically this setup in leading subcomponents indicators, you will see that reflected, generally speaking, 3 to 4 months ahead. This has to do with the momentum of inflation slowing down, which I want to stress out is quite different than inflation collapsing towards 2% straight away. And therefore, while the momentum might be positive, or at least where we want it to see, because God forbid we're going to see the momentum of inflation further accelerate from here, it might not be enough for the Federal Reserve to feel comfortable because their mandate remains 2% and not 3 or 4 or 5% wherever inflation is going to settle.
All right, so I think when people look at some of the performances of the crypto market, obviously they're following inflation as a very big indicator that helps. Obviously, when we see a CPI number came down just here in August, we saw a little bit of a rally happen with Bitcoin. If you look at some of the numbers, this is the Q2 22 recap. I was just looking at some of the a recent report. Bitcoin's second worst quarterly performance in its history, turning this is a negative 56%. Ethereum also declined by 67%. With these kind of at the bottom right now, because I think a lot of people would look at where this portfolio, when you think about a crypto portfolio, sets, and many people are looking at the current situation, maybe we're at the bottom here. It's very possible that we could be nearing a bottom on inflation. Your thoughts on, and I guess this is my concern, because I'm in the camp of that we still have more pain coming because of the lagging indicators that start to push into the market: real estate, credit, which will be consumer credit problems later, and most likely jobs. So those kind of syndicate or indicators right now that we're looking at over the next 6 months, to your point, what happens in September if we do see a slight tick up in CPI again, even though we had a nice tick down here in August? What do you think goes on then?
So I think the risk reward and the different scenarios ahead of us in market pricing in risk assets, so that can be equities or can be crypto, is actually pretty skewed on the downside. Why do I say that? If inflation would surprise further on the downside, let's say, so we would have a momentum of inflation slowing down, it really depends from the magnitude of this slowdown, but it has been kind of priced in. So markets have been very sanguine in pricing in a Fed pivot. Although there won't be any Fed pivot near anytime soon, markets are forward-looking and they're assuming, Paul, that if inflation keeps slowing down, the Fed won't hike anymore. They'll be happy with it. Now, I doubt already that this interpretation was the correct one, but this is what's been priced in pretty aggressively. Now, imagine you move on the other side, as you correctly asked, then say inflation upticks, then none of that has been priced in all over again. So you would need to price a Fed that is extremely more aggressive because they told us that it will be data dependent. So if data don't actually work the way they want to see it down, and again, it has to do not only with the momentum, but also with how fast inflation goes down to 2% and where does it settle and what is the composition of the inflation basket. It's not as simple as looking at just one indicator. They told us that they want to see major progress from that perspective before they even think about taking the foot off the gas pedal. Now imagine if inflation starts to worsen again, they'll need to be ultra aggressive to make sure they put themselves in front of the curve and send a very strong signal to markets.
Yeah, I was looking at this, the growth assets return chart here, and this of course has, some pretty interesting traditional stocks in here. Obviously we had Peloton, which has taken an absolute beating this year. Netflix also seeing some big corrections and then a little bit of sideways action. Roblox, Snap, and then Bitcoin, even right there in that same framework. If you look in comparison to growth asset returns and the performance, all of it in a downtrend, which is most of the S&P, even though today we're seeing some S&P movement. With that being the case, and at the same time, we're also seeing a little bit of a downtick on Bitcoin and Ethereum again this week. I guess the question is how important, because September feels like a very important month to me with a new CPI coming out, an FOMC meeting happening, and possibly an ETH merge. So we got a lot of things that could really start to muddy the waters. What is your anticipation of how this plays out over the next really 45 days?
So, Paul, what I tend to do again is try to assess probabilities because I don't have a crystal ball. So I have to think about what the market is pricing in several asset classes against what I think is my base case macro speaking, right? My base case macro speaking is that real economic growth is going to further slow down and pretty aggressively so, much worse than people are currently pricing in and analysts are expecting. That's from a growth perspective, right? Then I have the inflation story. And on inflation, forward-looking indicators are pointing to some moderation of inflationary pressures. All right, that's okay. But then the market is already pricing those in, A, and B, they're pricing a reaction from the Federal Reserve that will be pretty lenient. It will be very loose and very easy, accompanying this drawdown. And I don't really think that is the correct interpretation. So the balance of risks right now, given how markets have strongly reacted to this notion of Fed pivot that I think is misplaced, and given the fact that I expect also growth to deliver on the downside, I think that the risk reward is rather on being defensive than on being offensive when it comes to taking risks right now. I would lean on the defensive camp.
Interesting that you say that. You look at quarterly returns of assets right now. You got Bitcoin. This is just kind of a lineup that was in this report. Bitcoin, ETH, Luna, Sol, XRP, etc., Nasdaq, all in the red. Here on Q2, in a big way. So we've already taken, the market is taking a big tumble. Now the question, and the billion-dollar question, trillion-dollar question today is always, have we hit the bottom? Are we starting to scoop along the bottom and get a chance to kind of get our legs under us from going forward? Back to me, I still feel that we've got a lot less or a lot more potential in the market yet to come. And most of the analysts I've talked to so far, whether it's Mark Yusko or Gareth Soloway comes on our show, we've had guys, Dr. Bear's been on, we call him Dr. Bear. And we've looked at a good variety of almost everybody pointing in the same direction, as they think there is more downturn coming, both for the S&P, but also for the major crypto assets. With that being the case, let's assume that is going to be the fact that we're all on the same page. What would be able to get us moving out of this? What are some of the key triggers you would watch for? Because you need to get an early mover position. So what would those be?
I really like this question because it helps me thinking like in chess. In macro, you need to think the next step further, not only one step ahead of you, but multiple steps ahead of you. So in 2019, to answer this question, I'm going to use an analog, which is 2019. In 2019, the equity market delivered, and also risk assets in general, delivered major positive returns. If I would ask you now, Paul, what was the earnings per share growth in S&P companies in 2019 year on year? Then the answer would be, 10% probably, because if the market delivered so well, growth must have been good. It was 0%. Earnings per share in S&P 500 companies in 2019 grew 0%. So the market delivered very major returns because of valuations. And the valuations were effectively boosted by a Federal Reserve, which was doing their utmost best to stimulate markets and stimulate the economy. So what I need to see right now, if my base macro assumption is right, that the economy is going to roll over, is a Federal Reserve that is recognizing, Paul, that is happening. It's recognizing that the downside in growth is hitting inflation as well. It's hitting the labor market harder than they want the labor market to be hit. And basically, they're recognizing they've done enough damage. So when you are at the 8th inning of the slowdown in growth, at the 8th inning of the slowdown in earnings, and policymakers are recognizing that maybe they've done enough damage, exactly like in 2018, late 2018, when Powell was hiking rates, cutting the balance sheet, when there was enough pain that he said, well, okay, that's enough. That is one of the main signals that I have to be more aggressive on risk taking.
Okay, so in that period of time, we've got a lot of commodity action happening with both fuel. You look at just the lineup here: coffee, crude oil, natural gas, lumber, copper. Everything's kind of taken a big hit. Obviously, lumber and building supplies, we see and know why that is happening. Copper's down. You got crude oil also kind of coming into at least a flat position. Likelihood we could see a little bit more decline on oil, which obviously would affect some of the key factors within the structure of what inflation does. And with all those kinds of scenarios, we know those kind of things because those are kind of the lagging indicator or the early indicators of what's happening right now. What do you think about jobs and the housing, and then also retail credit crunch? Where will those play into this in the next, say, 90 days to 6 months?
Yeah. Another good question, Paul. And before I answer, I want to remark something on commodities, because this is a very smart point, and I want to focus on copper for a second. So copper is basically the bellwether of global industrial activity. It's used in anything we can imagine effectively. And so it tends to lead very well economic cycles and also asset returns. It's a very good cyclical growth indicator, and it's been simply collapsing. I mean, you put up the chart and you can see that, well, if you compare it to lumber is even more cyclical because it's used in housing mostly, but copper is broader as an indicator. So I like to follow that a lot, and it's been collapsing. So it is a signal that economic growth is actually slowing down, right? So when you look at that, so what about the job market? Let's talk about the job market for a second. So the job market is a coincident to slightly lagging indicator of the status of the economic cycle. And why? Because first, the economy slows down, credit becomes more expensive. Companies have to think about, okay, I have a business model where I used to lever up a lot. Credit was very cheap. I could borrow at 3-4%. Now I need to borrow at 7%. Oh crap, the business model doesn't work anymore. So growth is slowing down already. How do I handle this? Well, the first thing they do is they start investing less, they cut discretionary spending, they cut marketing, they cut all of that. But once they realize that is not enough, so later in the cycle, they are forced to cut costs. And obviously, they will look at their labor force as well. So the job market actually gets hit slightly later in the cycle. And inflation is actually the most lagging indicator of all. Inflation goes down only very, very late in the cycle once enough damage has been done to growth and enough damage has been done to the job market. Right now, we are in that situation where the job market is starting to weaken. And the last report of the non-farm payrolls would be like, Half, what are you talking about? It's 520 whatever thousand the BLS told us. Again, guys, I invite you to look at nuances. I published an article on the Macro Compass breaking down the labor market report. And if you look at the household survey, so basically not the statistical elaboration of the data, but simply, Paul, people getting asked about what job do they have? Do they have a job? Are they working how many hours? Most of the job creation in the household survey comes from multiple job holders and part-time people. There has been no increase in full-time workers since March, according to the household survey, none at all. And all the increase, or most of it, has been generated by multiple job holders. Now, the BLS, the normal non-farm payroll report, accounts multiple job holders as two jobs created. So if I have 2 jobs, then the non-farm payrolls will report 2 jobs being created. But in reality, it's me actually having to work 2 jobs to make sure I can make ends meet, right? And the household survey corrects for this distortion. There are many other nuances that actually point out to the fact that the job market is doing okay, but this is starting to weaken as well. So I expect going over the next 90 days to start to see some disappointment as well into non-farm payroll, the more classical measure everybody's looking at. And it is just part of the cycle. You have forward-leading indicators going down, and the coincident to lagging indicators, well, it's about time they start to drop too, right?
Yeah. And that is the concern I have, because those lagging indicators are the ones that really are the precursor to a true bottom to be coming in, because obviously you do get jobs, the lagging indicator of real effect on housing markets, which we're already starting to see in the lumber side of things. And again, remember, you guys are tuning in here because you're looking at crypto assets, maybe some traditional assets, and you're thinking, when is the best time to buy? Am I in a good position, maybe exit a position right now, because we are seeing a little bit of a rally? These are the kind of questions that you have to be asking and watching all the time. So make sure and drop some questions in over on the side bar and smash the like button. We'd love to get your feedback on this. Alfonso, I want to go into a couple other things here. And this is, you got Elon Musk coming in and saying, hey, inflation is now peaked, possibly a milder recession than what a lot of people looked at, maybe seeing a deep cut recession in the potential next really 12 to 18 months. When you look at Elon, and we'll just say he has an interesting perspective on the global aspect, but he does follow macro trends, and obviously he has 3 major companies. They get a chance to see that in real supply chain elements as well as retail sales. With all of his insight, do you feel like he's on the right track here, or do you think Elon might be overstepping it right now?
I think Elon has an assessment which is very rosy. I mean, what he depicted out there, Paul, a mild recession with inflation coming down, basically, is exactly what would benefit Tesla the most, to be honest, because that would allow the Federal Reserve to take the foot off the gas pedal, because inflation has peaked and it's coming down aggressively. There is also a mild recession on top of it, so earnings don't really drop off a cliff. So, basically the Fed can become accommodative. The economy isn't really rolling over very hard. That's perfect for risk assets in general, right? So always remember in this business, despite I think Elon is a very smart guy, but in general, everybody talks its own book. It's always been the case. It will always be the case. Now, with this in mind, obviously, the other thing I want to point out is the following. Looking at the probability that this will be only a mild economic slowdown, let's assess the facts. So the world overall, because you said this is a global show, so let's talk about the world. In the world, there is something like over $200 trillion of private debt. So everybody talks about government debt to GDP. I look much more at private debt to GDP. And why? Because while the government can just issue the currency, I can't, you can't, and our audience can't. If we have a liability, we need to be able to service that liability with cash flows, with earnings, with salaries. Otherwise, it doesn't work. I cannot ask the bank to print some money to pay off my mortgage. They won't do that, right? So private debt is much more prone to financial accidents, basically speaking. And right now, there is over $200 trillion equivalent of private debt in the G20 economies. Now, that's normally doable because real borrowing costs for the private sector have been very low. Interest rates all over the place, adjusted for inflation, have been extremely low over the last 5 to 10 years. That has helped people lever up. Think about the mortgage, right? I mean, if the mortgage rate is 2% or 3%, you can definitely afford buying a house, which is $1 million worth, maybe, because the monthly installment becomes smaller as your borrowing costs are pretty limited.
Right.
Now, try and redo the same borrowing activity, having jacked up interest rates and real interest rates adjusted for inflation as quickly as we did. A reminder, the spike up in 2-year yields in the US, but also in Europe, in Australia, in Canada, in New Zealand, everywhere in the world, has been the fastest ever on a 6-month rolling annualized change over the last 40 years. Also, mortgage rates, the change in mortgage rates in America, 30-year mortgage rates went up from 3% to 6%. Mm-hmm. It's a 300 basis point move over the shortest period of time in history.
Right.
Such a dramatic change in financial conditions, in borrowing rates, while there is so much private debt in the world. And again, government debt also matters, but the government can just issue more currency. They have that ability. I can't, and you can't, and our listeners can't. Yeah. So if they have so many liabilities to service and borrowing rates have exploded so quickly, it is so complicated to engineer a soft landing with such a leveraged economy and financial conditions having to tighten so aggressively all at once.
Yeah, and I want to jump to, because I think that's the exact point I'm getting at is, and this is coming right from your blog, The Macro Compass. You kind of talk about this, and that is strong labor markets coupled with the preliminary signs of inflation slowing. It kind of creates this euphoria-like, risk assess or assets that we're kind of seeing in a little bit of a micro pump right now. With that being the case, kind of explain what you were talking about here of this Goldilocks position that we might be in versus, say, a true soft landing, and how to interpret those two.
Yeah, first of all, the Goldilocks comes from a story of the Goldilocks and the Three Bears, I think it was, right? So everything, and the story goes like, the world is not hot, it's not cold, it's just perfectly, it's just right. And so what people interpreted is that market conditions were just right, not hot, not hot, not cold, but the economy was slowing down, yes, but the Federal Reserve is going to perfectly accommodate that slowdown. It's going to be great, a fantastic soft landing. And that is what the Goldilocks pricing means when it comes to markets and the economy, right? And I have to disagree with that, because there are two lines that actually don't really square in this Goldilocks pricing. The first is, again, I don't think that tightening financial conditions so aggressively as we did with such an over-levered economy is going to lead to only a mild economic slowdown. The pieces of the puzzle actually don't fit from a macro perspective there. Second, we have central banks that are not going to be lenient and nimble, and they're going to be, flexible. This is what we used to have over the last 12 years. But the last time we had drawdowns in labor markets or stock prices or risk assets, central banks could always step in and support markets. They could always do that. Why? Because inflation was 2% at best. Inflation expectations were 2% at best. So they always felt that there was no risk in basically lifting a sentiment and making sure this euphoria in risk-taking could restart all over again. Well, right now, guys, they cannot do that. Yeah. Inflation is extremely high, it's far away from their target. And because of my previous job, when I run money for a bank, I had the chance to meet these guys, central bankers, prime ministers. When you talk to them, Paul, what do they tell you is the following. Of course, off the records, they say that. On the records, they say something else. But off the records, what they said is, Alf, look, what we care about is to have a controllable environment where we can predict what's gonna happen and where the outcomes are socially acceptable. 9% inflation is far away from being socially acceptable. So their interest is fighting inflation, fighting inflation, fighting inflation. There is nothing in the hierarchy that says if the labor market is weakening a bit, we're going to ease. If the economy is weakening a bit, we're going to ease. There is, at the moment, because of their incentive scheme, this just can't happen.
Yeah, and I was looking at this report here. This is talking Binance basically saying retail investors are flocking to Bitcoin and crypto amid this rampant inflation situation. So as we see the markets kind of start to spread right now, because it's kind of like a scenario where everybody's looking for a safe haven. And is there something that could be out there where it's a risk asset like cryptocurrency, or maybe you're going into certain, other things, whether it's bond, gold, silver, whatever it might be, other commodities. When you look at that right now, obviously we see a little bit of growth. Would that be enough to start to drive the crypto markets to maybe recover first out of this recovery that we do slide through? Because we still know there's going to be more pain. Could the market get more investors moving into it? When I say the market, crypto markets, and actually start to see them move out, maybe lead the recovery when we do start to see that happen?
So, Paul, crypto and digital assets in general have this interesting property of having some very idiosyncratic features, some very, like the ETH merge. For instance, the ETH merge is very little about macro and is very idiosyncratic to the space. It's a digital asset feature, right? So the crypto space has a relatively large market cap, and it has these drivers that are very idiosyncratic to the asset class itself. So sometimes it can generate some interesting returns that are not correlated to assets in general, right? Now, back to today, though, I have to warrant caution. And why do I say that is what the Federal Reserve and the ECB and other central banks are trying to do is to make the cost of owning fiat currency a bit less bad than it was over the last 5 to 7 years.
Right.
Their willingness is basically to make you borrow less, because by making borrowing rates in real terms higher, and by rewarding owning that fiat currency idle without investing it, without making it flow through the economy, their objective is to slow it down hard enough so that inflation slows down too. And when they are so committed in making the cost of money or the return of money a bit better to hold the very fiat currency, obviously the marginal appetite to own other alternative investments, gold, real estate, digital assets, goes down.
Yeah.
Marginally speaking, not in absolute terms. So right now, crypto, as everything else, has cycles. It's an asset class you can consider for the long term in your portfolio because it has a lot of features, and we can discuss about that. But cyclically speaking, I think in this environment, it will tend to behave like a risk asset, which is priced in dollars or in euros or in any other currency. And the central banks are trying their best to make the denominator a bit more valuable. They take these dollars, these euros, and they try to make the real return on those more valuable than it was a year or 2 years, 3 years ago, which ceteris paribus lowers the appetite to take risks in gold, in Bitcoin, and in other asset classes.
I think it's a good point, because you're right. I think the key here is for the Fed, obviously, well, in general, global recession, or inflation numbers, they're still pushing for that 2%. And you kind of hit it on this tweet right here. But this kind of goes in the face of someone that I do follow a lot, and that is Chamath Palihapitiya. He's a big investor in tech. He has kind of gone on the position of that maybe inflation has a new floor. What you said in this tweet was, we all hope it comes down. Idea of maybe happy with 3 to 4, crazy. They're still going after this 2% mandate. So you have that position, and then you have some big business leaders think that maybe 3 or 4 is the new floor. What would be your argument there on that?
Well, Paul, the point is that it might be the new floor. What I would argue in that tweet that you posted back then is that the Fed isn't going to like it, because
Yeah.
the broad argument is the new floor for inflation is 3 to 4%. All right, we might debate whether that is the case because rents are very sticky and commodity prices are structurally higher and deglobalization and the supply chains and all the story we know, right? To talk about higher structural floor for inflation. My point is central banks are not going to endorse that. No way.
Yeah.
And the reason why they're not going to endorse that is that inflation targets for central banks are set in a way, Paul, that they are far away from deflation. Deflation is a poison for a credit-based system. It makes your liabilities more expensive, basically. And if you continue to borrow, at some point you're going to go belly up. So our system is based on creating more debt. And if it's a deflationary system, it just doesn't work. It doesn't square. So they put their inflation target far away from that, like two percentage points away from a potential deflation. But they don't put their inflation target at 3 or 4% for a reason. Because once inflation expectations start to be anchored higher, if inflation prints at 3%, 4%, and a central bank is happy with it, people are going to assume that the wage growth they're going to need to ask next year has to be 5% or 6%.
Yeah, exactly.
It starts a vicious circle that it's very difficult to fight, and they really don't want that. No policy maker would wish to get in an environment that is very difficult to control, very unstable equilibrium. They don't like that.
Yeah. Well, you're right. It would change the framework in which people would even look at inflation. Essentially, that would change the entire global economic structure because of the fact that we've worked on such a low inflation number that everybody's tried to target for so many years. Last question to you, and then I want to get at least one question over from the audience to you, Alfonso, and that is how closely, as investors, how closely should we be watching what's going on in China? I just want to run through a few stories quickly. China shocks rate cut as data shows alarming slowdown. We've already seen that. You also look at this tweet right here, Henan province. This is where more developers collapsing, meaning real estate developers. China is now not, especially the banks now, having problems of actually bundling packages out into the market, the mortgage market. That's a problem. And then, of course, right here, learning the hard way that deleveraging biggest real estate market in the world bears, and this comes right from you, bears negative consequences for growth. How closely should we be watching this, and what kind of impact is this going to have on global economic growth?
Very closely is my answer, Paul. And the reason is the following. The largest single asset class in the world, it's not equities, it's not bonds, it's not crypto, it's not gold. It is the Chinese real estate market.
Yeah.
It is a $55 trillion worth market alone. That was the estimate in 2021. It's now worth less because it's, of course, coming down, crashing. And what I want to convey is China is already a very, very large force all over the world. We recognize that. But what they have done over the last 20 years is they have basically suppressed wages locally to enhance their competitiveness and keep exporting very cheap goods outside. But they have given Chinese people one way to lever up their wage extensively, which is credit, borrowing.
Yeah.
So Chinese people effectively have a very hard time investing abroad. China gave them one way to create a wealth effect via investing, and that's the property market. It has blown up the property market out of proportion, and that also helped fueling this Chinese demand that was the engine of growth for 5 to 10 years. And now all of that is coming down because China decided to clamp some of the excesses and the frothiness of this market. And this has the opposite consequences, where when you deleverage the biggest asset class in the world, it must have impact and repercussions as well on global growth.
Yeah. And that's what we, kind of try to coach our audience on a lot, is that you do have to look at some of these other markets that really do have a masterful impact on what's happening on a global perspective, but especially here in the United States as we get into that. So for sure. I know we got a quick poll, and then I have one question from our audience that we'll get to you, Alfonso, and then we'll let you go because I know you got a hard stop here. But let's take a look at the poll. Short term, 1 to 2 years, is global inflation good for crypto adoption? Yes, people are saying this is going to increase the adoption. Looks like that's kind of the winner here. Do you feel that that would be the case?
Well, the interesting part, I think, is that I think this is not necessarily wrong. I think that low inflation and low interest rates for a while and low real interest rates, that is probably going to increase adoption even further, because people would be looking for an escape route effective from the
Right.
system. So that would be, I don't think this is necessarily wrong. I just think the other side of it could enhance it even further.
Yeah, for sure. One question here coming from our audience: is there a possibility of the Fed tightening so much that we swing into a deflationary environment? This is a really good question. What are your thoughts on that? Could
Very
there
good
be
question.
a little bit of shift?
Yes. Yes, there could.
Really?
So
Okay.
yes, of course there could. So when you look at a disinflation strong enough to push us into deflation, what you're looking at is the basket of inflation. So what has to go down on a month-to-month basis within the inflation basket to push us all the way down on an aggregate level. And that is a combination of goods, energy and commodity prices going down, which we are seeing both. We are seeing goods
Right.
prices coming down, and we are seeing energy and commodities coming down. We are seeing services prices being very, very sticky. Now, what happens if the housing market goes down very aggressively? If that happens, then with a lag, also rents will have to drop. What happens if the labor market shows cracks because the Federal Reserve has tightened too much? Then wages will come down, and so rents will have to come down too. And then at that point, you might have the combination, which is good enough to actually bring inflation all the way down on a year-on-year basis negative. Now, of course, the base effects from last year will help in this process, because as we compare inflation today to inflation when oil was $130, then it starts to be a relatively an easier task to achieve. It's not my base case, but it could be the case.
Yeah, I think we're going to have to watch that very closely, because obviously things have to play out in those scenarios here. We could see this is the strategic position. Really the next 3 to 6 months is going to be, I think, the real hot zone of how this thing plays out for the next cycle coming into it, at least from a bear market approaching, and us getting out of a recession, all those kind of things that help the global position. Obviously, China plays into this and all that good stuff, but crazy stuff. Hey, Alfonso, it's been great having you on. We're definitely going to get you back on the show for sure. We're going to take a few more questions, but then you have a hard stop. So thanks for stopping in. We appreciate it.
Paul, it's been my pleasure. Thank you very much for having me here. And anytime you want to call me back, feel free to do so.
You got it. We'll bring you back on for sure. All right. So you guys, we'll try to jump into some more questions, because I know you guys had a few coming in. Coming in from Rolo. Okay. So difference between 2008 and now with the housing market, corporate entities like Blackstone, Zillow, have 50 billion in cash ready to buy up houses dumped on the market. So I think the scenario right now, I don't necessarily think, I was around in the 2008 crash, had businesses that were not necessarily affected by the real estate side, but were affected by the massive adjustment in lending to businesses, which is going to be a factor, I think, that will continue to be a big one here. But you're right, there will be some markets where especially housing prices, are going to get suppressed so much so that we're going to see some movement into the space from some of the big players. Definitely will happen for sure. Brum Monster coming in. Will the Fed print this month, next month? Not at all this year. I think here is the factor that we're watching very closely. And this comes from what Alfonso was talking about, is that right now, and this is my position, you guys know me, if you follow our channel, I'm a fairly conservative investor, and I do look at the macro element having a lot more effect on the crypto and digital asset space than I think a lot of people give it credit for. And the thing that I'm watching for right now is that we are still positioning in for a downward trend. And again, it goes because of the aspects of these trailing indicators that we have yet to truly see. That will be jobs, it will be housing. We will see it in the credit crisis that will come with this, because it's just the natural effect of a cycle that we're going through right now in any inflationary scenario, and especially in recessions, that if you've lived through them, you understand these cycles, especially if you've run businesses in them, you really understand this, because it does start to affect that. And what Alfonso was talking about is the pressure on small business is going to be very big. That's the concern right now, because that will go into Main Street. And once we get into Main Street, if the pressure is so much, that's where you'll start to see some very big effects. So to your question, will the Fed print? If they see a quick ramp up and we get into a very precarious situation with the global or the US economy, I think the Fed does try to print their way out of it, because it could overcorrect and get themselves in trouble. And that is a problem that could cause some massive moves in the marketplace. But more importantly, it would cause massive moves into crypto, which is the good part of it. But I think at the same time, we're probably going to see a little different scenario paint out. I think September is the month that we have to watch closely right now. You've got three big things happening. Obviously, a new CPI print. I think it's going to end up ticking up slightly. We may not see the 9 number again, but it will tick up slightly. And then you've got ETH and the FOMC meeting. So all that's going to be rolling in. Listen, stay tuned here. We're going to drop another live stream for you guys today, getting into some very big moves on the Fed banking aspect and what this means to traditional banks, how crypto could be held more so in banks themselves. If you're listening in over on the podcast, join us here on YouTube. This is the place to catch it all. And of course, if you have not joined the Diamond Circle, jump in right now. It's really easy. Click the link below. If you want to reach me, it is out there on Twitter @Paul Barron. We'll catch you next time right here on TechPath.